Hello and welcome to the Global View on this Tuesday. Well, US Treasury yields have moved higher as investors in the market consider ballooning US government debt issuance and rising geopolitical risks. Diplomatic efforts to arrange a ceasefire to let aid reach the besieged Gaza Strip failed overnight. Meanwhile, Israel has ordered the evacuation of communities near its border with Lebanon, prompting fears the war could spread to a new front. The yield on the 10-year Treasury note rose to 4.7%, while the 2-year was up to 5.09%. And US economic data shows the New York Fed's Empire State Index, a gauge of manufacturing activity in New York State, fell to negative 4.6 in October against expectations of a drop to negative 7. The US dollar mixed as investors prepare for speeches by Fed Reserve officials this week for further clues on the direction of interest rates. The Aussie dollar has bounced higher to trade at 63.4 US cents. Well, for detailed analysis of currencies, and in particular a look at if the strength of the US dollar is sustainable, I spoke with Chester Ntonifor from BCA Research, who also offered his view on the Aussie dollar.
We are seeing a confluence of factors. So we know that the US dollar reacts to geopolitical tensions in the sense that it's a safe haven currency. So it tends to rise when you have these conflicts. There are also like a few fundamental factors that are affecting the US dollar. The first is what's happening to global growth. In a sense, the US dollar tends to be an anti-cyclical currency. If global growth is weakening, the dollar tends to strengthen, and vice versa. So the weakness that we've seen in global growth, especially growth coming out of China, has helped the dollar. It's also the case that when you look at the key driver of the dollar has been interest rate differentials. Interest rate differentials have been strongest in the US, at least based on market measures. So you've been having this tremendous inflows into the US that has also supported the dollar. So you've had a confluence of factors. You've had the fact that you have this geopolitical crisis. You've had the fact that you have slowing global growth, and you've had the fact that you also have interest rate differentials that are moving in favor of the dollar.
So, of course, we have seen continued strength in the US dollar. Do you feel as though that is sustainable, or is that going to depend particularly on those geopolitical risks?
So the geopolitical risk for the US, the interesting factor about it is that the geopolitical risk stems from the fact that we're going to get higher oil prices, we're going to get higher natural gas prices. And the reality is that the US is the biggest producer of oil in the world right now, much more than Saudi Arabia, much more than Russia and all of these countries. So you have seen the correlation in the dollar change a little bit, in the sense that higher oil prices, higher geopolitical risk, you have the safe haven inflows, but you also have the fact that US terms of trade, the US trade balance benefits from this. Going forward, I would say one thing that has caught my attention is it's become a popular story. We know that the dollar's rallied. When you look at the DXY index above 106, when you look at next speculative positioning across various measures, we know that most investors are long the dollar. So it's becoming a very, very popular story. So my narrative has always been, we'll get a little bit of upside, but the upside is going to be very limited because this is now becoming a consensus trade.
All right, so you're feeling perhaps it is reaching exhaustion, and also when you take a look at positioning at the moment of those bulls being long in the US dollar, clearly.
That is true, and you're seeing it vice versa, right? One of the factors that has helped the dollar has been the fact that interest rates have been quite high in the US relative to other markets. For example, Japan, for example, Switzerland. We've seen the yen get decimated. We've seen the Swiss franc correct a little bit. So to the sense that we get geopolitical tensions, inflation comes down, central banks become a little less hawkish, then of course that will put a cap on how high the dollar can rise, given that it's been driven by interest rate differentials.
So based on your modelling, what's your strategy then, just as far as the US dollar is concerned?
In the very near term, the dollar tends to be a momentum currency. So typically, when you're seeing speculative positions increase, as we're seeing right now, when you're seeing, like buying in the dollar increase, as we're seeing right now, you typically want to be positive, and wait for that momentum to reverse. So in the very near term, I am positive. So that's one angle of looking at it. But again, when you look at the fact that most people that want to be long the dollar are already long, and you look at the fact that, quite frankly, in general, the dollar is the most expensive G10 currency. So if you have a 2 to 3 year time frame and you look at models, at least my models, they suggest that if a currency is expensive, you want to be shorting it over a 2 to 3 year time frame. So I'll be selling the dollar on strength. I will not sell it today. But as it increases higher, I'll be selling because the other factors are going to come into play for a lower US dollar. Valuation being one of them, as I mentioned, and the fact that most people that want to be long the dollar today are already long.
And Chester, of course, those looking for a safe haven asset, while considering the US dollar, also favouring the Japanese yen. What are you seeing there at the moment? I guess particularly focus with potential for intervention there in the currency from the Bank of Japan.
Yeah, it's a very good question. So, what has driven the Japanese yen very strongly has been what's been happening with global yields. We've had a massive wave of carry trades. People have been shorting the yen. They've been buying other currencies that are yielding higher. And even though on the announcement of the change in yield curve control, we got a higher adjustment in the yen value, we've seen that fade in recent weeks, given that people have just assumed that that 1% ceiling is going to be still attractive to short the yen and buy currencies that are yielding 5-6%. And when you go to emerging markets, those emerging market currencies, Mexican peso, Colombian peso, all of those currencies become very, very attractive. So the yield differential story is working against the yen right now, but everything else is working for the yen. So again, from a contrarian point of view, I tend to be a contrarian. Massively shorted currency. Everybody is negative. Everybody is talking about the fact that the Bank of Japan is not going to be able to do anything, especially if we get this disinflationary wave that is happening in the world. I mentioned valuation earlier. It also happens that the yen is the cheapest G10 currency. So if you go back at our models again, and you tend to look at what you would expect in terms of expected returns for the yen over the next 5 years, over the next 10 years, we're talking of returns of an annualized basis of around 7 to 8%, even when you adjust that for carry. So you're still going to be making money for carry. So very, very cheap currency, heavily shorted. So a very, very big contrarian trade. But of course, what happens to yields matters a lot.
And Chester, what's your view then on those commodity-based currencies, particularly the Aussie and also the Canadian dollar, with a view to what China is doing at the moment, given we've seen that, particularly with the Aussie dollar, the fortunes of the Chinese economy very much playing with the Aussie dollar at this point?
Yeah. So commodity currencies, they tend to be driven by interest rate differentials. That's one point, but of course they tend to be driven by what's happening to commodity currencies. When I look at the Canadian dollar and the Australian dollar, on a long-term basis, given the view that I'm negative on the US dollar over a longer term horizon, I'm positive on these currencies. On a very short horizon, given what's happening in the near term, I tend to be more positive on the Aussie compared to the Canadian dollar. And there are a few reasons for this. A lot of the indicators that I look at suggest that pessimism in China is a widespread consensus view. Everybody is expecting that the real estate market is going to collapse, it's going to destabilize the economy, and that is obviously going to weigh on the Aussie relative to the CAD because Canada sells mostly to the US or Australia sells mostly to China. So, from a contrarian viewpoint, I think that if there's any positive news that's coming out of China, you're going to see a big rally in the Aussie relative to the CAD. The second more important point, it's what's happening in real estate. So we know that one of the ways in which monetary policy affects the economy is through the real estate market. And simply here where we're sitting in Canada, residential investment is a much higher share of GDP in Canada compared to Australia. We're close to 8% in Canada, we're closer to 5% in Australia. So, to the extent that monetary policy can be lifted a little bit higher in Australia relative to Canada, to the extent that the Chinese economy surprises to the upside, I think AUDCAD is a good bet. Longer term depends on the trajectory of the US dollar. I think if you're just looking at CAD USD, AUD USD, they are both commodity exporters. Australia more liquefied natural gas, Canada more um, uh, uh, like a Western Canadian select oil. Those who benefit from any crisis in the Middle East. But shorter term, I'll prefer Australia relative to Canada.
That was Chester Ntonifor there from BCA Research, his outlook on currencies. Well, let's just briefly head across the ditch. New Zealand's consumer price index coming in cooler than expected, rising 1.8% in the third quarter on the prior quarter. This compares with a 1.1% rise in the previous quarter. Annual inflation easing to 5.6% from 6%. Food being the largest contributor to the September quarter inflation rate due to rising prices for products such as milk, cheese, eggs and bread. That is the global view for this Tuesday. Just before we go, a check of where we're likely to get going in just a couple of minutes' time when the local market opens. As you can see there, set to be positive. SPI futures up close to 0.7%. Stay with us. The open is just a couple of minutes away.